In the span of 48 hours, the market printed a move that most traders spend entire careers waiting to see. Gold didn't drift higher. It didn't grind. It detonated up more than 6% in a single session, sprinting to around $4,957 an ounce on February 3rd, 2026. That's not a normal risk-off bounce. That's a structural repricing. And it happened while the US dollar slid toward levels it hasn't touched since early 2022, and the bond market widened a key spread that almost never gets mainstream attention until after the damage is done. Here's why that matters. Gold is not just a commodity. In moments like this, it behaves like an alternative form of trust. It behaves like collateral. And when collateral starts moving overnight, it's rarely because the crowd suddenly got emotional. It's because the system's largest players are changing what they hedge, how they hedge, and what they will accept as good enough protection. They said a move like this couldn't happen without a crisis splashed across every headline. They said gold couldn't leap like that unless the world was clearly on fire. But markets don't wait for the headlines. They write the headlines. Institutions move first, narratives arrive later, and everyone else realizes what changed only after the price has already shifted the playing field. What I'm about to reveal isn't a hot take. It's a pattern. It's a sequence of signals that repeats when the dollar comes under pressure, when the bond market starts whispering a different story than the stock market, and when the plumbing of derivatives forces hedges to rotate, sometimes into gold, sometimes into anything that can survive a night of margin calls. Welcome to Macro Ledger, where we decode signals institutions move on, before they become loud headlines everyone argues about. If you're the kind of person who prefers data over drama, you're in the right place. And if you've ever wished someone would connect the dots without yelling, consider subscribing if you value calm, cycle-tested analysis. Also, drop a comment with where you're watching from, because this story looks different depending on what currency you live in. Now let's reconstruct what actually happened. On February 3rd, 2026, gold delivered a one-day surge that immediately pushed observers into two camps. One camp called it fear, the other called it a squeeze. But the more useful question is not what people called it. The useful question is what conditions had to exist for a move of that size to occur without the usual prelude of weeks of positioning. A 6% day in gold is rare. It breaks assumptions embedded in models, in risk limits, and in the quiet spreadsheets that decide how much capital can be deployed without triggering automatic de-risking. That level matters because it's not a quirky move against one currency. It's broad. When the dollar falls that fast, it's not just about trade balances or a single data print. It's about global preference. It's about funding. It's about whether the world wants to hold dollar assets at the margin. Then the bond market added a third note. 728 percentage points, the widest since January 2022. That combination, dollar pressure, a steepening curve, and a violent gold move, doesn't fit the tidy stories people like to tell. In the clean narrative, a falling dollar supports risk assets, a steepening curve signals growth, and gold rises gradually as an inflation hedge. This was not gradual. This was compressed. This was abrupt. This was the market forcing a decision. Here's where it gets interesting. The biggest moves often happen when something technical forces a decision, when hedges stop being a theory and become urgent. And in January 2026, the clearing machinery behind precious metals futures changed in a way most people never read about, even though it can change behavior overnight. CME Clearing issued a notice dated January 12, 2026, describing a shift in margin methodology for precious metals, moving from fixed dollar margins to percentage of notional. That sounds boring until you realize what it does. When margin becomes a percentage, the required collateral scales directly with price. If the price rises, the cash required to hold the same position rises automatically. If volatility rises, the system becomes less tolerant of leverage at the exact moment traders most want flexibility. 5% for high-risk portfolios. 9%. Those are not tiny distinctions. They are mechanical constraints. They decide who can hold exposure through the close, who can carry risk across a weekend, and who is forced to cut because their collateral budget just got eaten by a formula. Now, a margin shift doesn't cause gold to rise by itself, but it changes the cost and feasibility of certain hedges. It changes which structures are efficient. It changes whether a hedge can stay on when volatility spikes. And it changes the behavior of the participants who dominate volume: banks, asset managers, commodity, firms, and the clearing members that stand between the market and settlement. This is the part most people miss. When the cost of carrying a hedge rises, some institutions don't reduce hedging. They change hedges. They rotate from one instrument to another. They shift from derivatives that demand rolling collateral toward hedges that behave more like durable insurance. Gold fits that niche because it is liquid and not someone else's liability. It doesn't depend on the ability of a counterparty to perform at the moment everyone needs performance. It can act as collateral psychologically. and in some contexts, literally, because it is recognized across borders. That is why a commodity can suddenly trade like a monetary asset. To understand why February 2026 looks like a regime shift rather than a one-off candle, you have to zoom out and see how this playbook has shown up before. In 1971, the dollar's anchor changed when the US closed the gold window. The decade that followed was defined by currency volatility and inflation surprises. Gold, released from a fixed price, repriced what money meant. In 1979 and 1980, amid inflation fears and geopolitical stress, gold surged again. The result wasn't just a higher gold price. The result was a repricing of trust and a world that demanded higher yields to compensate for the risk of holding paper promises. In 1998, the shock was not inflation. It was leverage. Long-term capital management revealed that models built on stable correlations can fail when liquidity disappears. Funding markets tightened, spreads widened, and while gold was not the headline chart on television, it played its traditional role as a hedge against systemic strain, especially for those holding assets across currencies. When the system questions its own plumbing, safe becomes a relative term. In 2008, collateral became the story. The crisis is remembered for failing banks and collapsing credit, but the deeper lesson was about what counts as money in a panic. When collateral is questioned, the system demands more of it. When the system demands more of it, anything perceived as higher quality collateral becomes more valuable. That's one reason gold's sharpest days cluster around funding stress. So when February 3rd, 2026 gets compared to 2008 in terms of daily move, the comparison is a signal. The market is reacting to stress in the system's architecture, not just to a narrative. And then the early 2020s taught a new lesson. After massive monetary expansion and then rapid tightening, the world rediscovered that the dollar is not simply a currency. It is the operating system of global finance. When that operating system glitches, when the dollar weakens sharply while rates send mixed signals, hedges migrate. Because the system starts looking for things that can survive stress in the chain of promises. So who is positioning, and how does the positioning express itself? Start with the slowest, heaviest buyer. Central banks. They don't chase candles. They accumulate gradually and think in years. World Gold Council data for full year 2025 shows central banks bought about 863 tons of gold. In the fourth quarter alone, purchases were about 230 tons, roughly 6% higher than the prior quarter. Poland added around 102 tons over the year. That is not a retail stampede. It is a strategic shift in reserves, a slow migration away from exclusive reliance on paper claims. Now add the faster institutions, banks that make markets, funds that manage risk across regions, corporates that hedge revenues, and sovereigns that hedge debt servicing costs. These players live inside the world of derivatives. Their daily work is to neutralize exposures. But when the dollar is under pressure, the cost of neutralizing exposure can change faster than their mandates. If you hold US assets but report performance in another currency, the dollar is a hidden variable. A falling dollar can erase returns, even if the asset itself rises. The simplest hedge is an FX forward or swap. But those hedges require collateral, they have to be rolled, and their pricing depends on interest rate differentials and funding conditions. When the yield curve steepens and funding assumptions shift, the cost and capacity of that hedging system changes. At the same time, many institutions hedge not just currency, but volatility itself. They use options, they use variance structures, they use portfolios built on historical correlations, but those correlations can change precisely when the dollar is moving. A hedge that was diversifying yesterday can become a source of stress today because it suddenly draws margin or because it suddenly moves in the wrong direction at the wrong time. This is where gold enters as a different kind of hedge, not a perfect one. Not a mechanical offset for every currency move, but a hedge that sits outside the same web of counterparty promises. If the world is repricing the desirability of holding dollars, even slightly, gold becomes a candidate for rebalancing because it is not denominated in a national promise. It is priced in dollars, yes, but it is not a dollar liability. Now let's talk about the dislocation, the part where two markets tell opposite stories. On one side, you have the paper world, FX forwards, swaps, options, and futures. This world is fast. It can create exposure with a click. It can hedge billions without moving a physical object. But it is also a world where exposure can be multiplied by leverage, where collateral demands can rise suddenly and where the same asset can be pledged multiple times through chains of rehypothecation. On the other side, you have the physical world, allocated metal, vault inventories, bars that need to be transported and assayed. This world is slower, it's less flexible, but it is harder to fake. When stress rises, the paper world moves first because it can. The physical world responds later, often through premiums, through delivery demand, and through changes in how much metal people are willing to lend or lease. When the dollar comes under pressure, the paper world can attempt to hedge instantly, But if the hedging tools themselves become constrained through margin changes, through higher funding costs, through thinner liquidity, then the logical move is to shift toward an asset that is less dependent on the smooth functioning of that paper world. That is why gold's move can be concentrated and violent even when other commodity charts look ordinary. This is also why the margin methodology shift is so important. Percentage of notional margins mean that as prices rise, the system's demand for collateral rises too. That can force participants to choose, either commit more collateral or reduce exposure. If a participant reduces exposure, they often do it in the instrument that has become most expensive to hold. But they still need a hedge, so they migrate into hedges that require less rolling, less counterparty dependence, or simply behave better under stress. Think of it like a city during a sudden storm. When the roads flood, people don't stop traveling. They change routes. They seek higher ground. Markets behave the same way. When the derivatives highway becomes expensive or crowded, hedges rotate into whatever feels like higher ground. Let me make the mechanism even clearer. In a calm market, risk can be carried with thin collateral because price changes are assumed to be limited. Many strategies are built on that assumption. But when volatility spikes, clearinghouses respond. They increase the collateral needed. They do it to protect the system from default. That is rational. But it has side effects. It forces liquidation. It forces a reduction in leverage. And it forces hedgers to reassess which exposures are worth the collateral cost. Now overlay FX hedging. If a fund holds global assets, it is constantly balancing currency exposures. If the dollar weakens, some hedges pay off, some fail, and some become more expensive to maintain. If the fund is leveraged, it might face margin calls not because its thesis is wrong, but because the path is volatile. In that moment, the hedge you want is the one you can keep through the night without getting stopped out by a collateral formula. That is the environment where gold can act like a collateral hedge. It can be held outright. It can be used in structures that don't require daily roll decisions. It can be held as a reserve asset that doesn't depend on the same funding rails. So when the dollar shows pressure and the curve sends mixed signals, the logic of rotating hedges into gold becomes stronger. Now notice how commentators contradict each other in moments like this. One camp will say the dollar is weak because growth is strong elsewhere, so gold is just momentum. Another camp will say the dollar is weak because confidence is cracking, so gold is panic. The data can support pieces of both, which is why the story gets noisy fast. But the market structure is often cleaner than the commentary. When the dollar drops quickly and a key curve spread steepens at the same time, funding and collateral mechanics become the real narrator, even if nobody says it out loud. You can also see the split between venues. New York sets much of the paper reference price through futures. London dominates a share of the over-the-counter flow where banks warehouse risk and corporates hedge quietly. Asian hubs express demand through different trading hours and, at times, different preferences for physical settlement. When stress is low, these venues stay tightly aligned. When stress rises, the seams show. Futures can gap on thinner liquidity. OTC markets can widen spreads. Physical dealers can become less willing to part with inventory without a higher price or tighter terms. That venue split matters because an overnight rotation is often a time zone story. A dollar move can begin in one session, accelerate in another, and force hedging decisions before the next region's liquidity fully opens. If a desk is running a book that has to be hedged continuously, it cannot wait for a perfect price. It must execute within the liquidity that exists. That is how sudden repricings are born. Not from a single genius trade, but from thousands of mandates to reduce exposure, rebalance collateral, and stay inside risk limits before the next margin cycle. This is why the phrase paper versus physical keeps returning in every era. It's not a slogan. It's a description of how claims multiply. In the paper world, the same underlying exposure can be represented by layers of contracts. In the physical world, a bar is a bar. When confidence is high, the paper layers are accepted because settlement is assumed. When confidence wobbles, the market starts valuing the simplicity of fewer layers. That simplicity has a price, and that price often shows up first in gold because gold is the simplest monetary asset that trades globally. Now, look again at the evidence in hard numbers, because numbers are what keep this grounded. Gold surged more than 6% to around $4,157 on February 3rd, 2026, a one-day move compared to the most violent moments of 2008. 8, signaling broad dollar softness, 728 percentage points, the widest since January 2022, suggesting the bond market was repricing future conditions. 9% of notional directly scaling collateral demand with price and volatility. Then add the slow foundational bid. Central banks buying about 863 tons in 2025, with 230 tons in Q4, and Poland adding around 102 tons. That's a base layer that can reduce the amount of free metal available for lending and can shape long-run confidence in gold's role as reserve collateral. Put it together, and the picture changes. This is not just a price story. It's a story about how the system ranks collateral and risk when the dollar is not behaving like the unquestioned center. So what does this mean next, without pretending anyone can see the future? Historically, when the dollar weakens sharply while the curve steepens and gold reprices abruptly, the next phase is not usually quiet. The next phase is about policy expectations, funding conditions, and the market's willingness to finance leverage. Sometimes the shock is absorbed and the system stabilizes. Sometimes the pressure repeats in waves. A conservative scenario is stabilization. The dollar finds support, the curve compresses, and gold consolidates as the system adapts to the new margin and funding environment. In that world, the February 3rd move becomes a boundary marker, a line the market drew to reprice risk, followed by a period of digestion. A moderate scenario is persistence. The dollar remains soft in bursts, the curve stays steep relative to recent history, and hedging costs remain elevated. In that environment, gold can attract ongoing institutional demand not as a trade, but as a balance sheet hedge. That demand doesn't need to be emotional to be powerful. It only needs to be consistent. An aggressive scenario is escalation. Dollar pressure deepens, policy expectations become unstable, and the plumbing tightens further. In that environment, the system tends to demand more collateral and punish leverage. That is when dislocations widen between paper prices and physical premiums, between official narratives and market-implied probabilities, between what looks calm on the surface and what is stressed underneath. In all three scenarios, the key is not predicting a number. The key is watching the indicators that signal whether the rotation is continuing or whether it was a one-time shock absorption. Watch whether DXY keeps spending time near the high 90s and whether it continues to drop in sharp bursts rather than drifting. Watch whether the 10Y-2Y spread remains near its widest level since early 2022, because that reflects how the bond market is pricing uncertainty and term premium. Watch whether margin and clearing policies continue to move toward frameworks that scale with notional, because that reflects the system preparing for volatility. And watch whether official sector demand remains elevated, because reserve managers don't buy for a headline. They buy for a regime. This is where the divide forms. Some people will follow the headlines and see a story about fear, inflation, or whatever narrative is fashionable that week. Others will watch the plumbing. They'll notice that the wealth gap is often an information gap, and the information gap is often hidden in boring places. Curve spreads, margin notices, reserve reports, and the quiet behavior of institutions that don't need to explain themselves on social media. It's not about being smarter. It's about paying attention to what the system pays attention to. Institutions don't wait to be certain. They hedge to survive uncertainty. And when the hedging regime shifts, the shift shows up first in dislocations and in sudden repricings, not in tidy explanations. That's why February 3rd, 2026 felt sudden. It was only sudden to the people who weren't watching the setup. The setup was dollar pressure. The setup was a curve sending a mixed message. The setup was clearing and collateral rules tightening in a way that changes behavior overnight. And the setup was a slow, official accumulation of gold that has been building a foundation under the market. So if you take one thing from this, let it be this. The market just demonstrated that hedging behavior can rotate into gold overnight when the dollar is under pressure and the rules of carrying risk tighten at the same time. That combination is rare, and it's revealing. This is macro ledger, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether the system keeps evolving. The question is whether you'll recognize the signals before the next overnight repricing forces everyone to learn them the hard way.